Hey guys, Max here, and this is your daily update for yesterday, the 13th of January, I think. It was a little bit of a hectic day. Markets took a turn for the worse, with tech seeing some very big dips, a couple developments in China, and just a few other things, so let's get right into it. Now, as usual, we'll start with the markets, and they were not too happy, to be honest. Tech in particular had a bad day, led by some of the mega cap companies we all know and love. Microsoft was down about 4% for the day. Tesla was down almost 7%. The Nasdaq as a whole dropped over 2.5%. Now, of course, these falls were pretty large, and they were certainly enough to drag down the rest of the indices, with the S&P 500 dropping 1.4% and the Dow Jones falling about 0.5%. The MSCI World Index as well, being very heavily American weighted, was down about 1%, so a pretty tough day all in all. Bond yields fell too, with the 10-year Treasury falling 4 basis points, and it now sits at 1.7%. Gold and oil also fell with the rest of the markets. WTI crude oil was down 1.4%, and gold was down 0.3% as well. Both of those commodities are still holding above $80 a barrel and $1,800 an ounce respectively. Now, with crypto markets, I think once again you're going to spot the pattern. They moved in line with risk assets like tech stocks. The market as a whole was down, though to be fair, not by a huge amount. Bitcoin was down 2% and was sitting at just under $43,000 while making this video. Ethereum was down about 3% and was sitting at about $3,200. The rest of the market, the altcoins were down a little bit more on average, most seeing something like a 4% drop. Now, we don't normally talk about Dogecoin in particular because I just don't care about it, to be honest, but Doge was actually 6% up on the day at first before continuing to ride up to 15% by the time I'm actually making this video. Now, the interesting thing here is I was preparing for this video yesterday and I looked at Dogecoin's price and it jumped up about 6%, and I tried to work out what caused it. I looked at any new news articles, I looked at Elon's Twitter to see if he had mentioned it, and nothing. I couldn't work out what had caused the pump, so I went to bed. Anyway, I then woke up and started to prepare for making this video again, and I found out that Elon tweeted after the initial pump that Tesla was accepting Dogecoin for payment for their merge. This, of course, caused a second pump that led to the eventual 15% rise in Dogecoin's price. Now, of course, that explains the second pump, but definitely not the first one, and I hate to sound cynical, but I would not be surprised at all if Elon had gone out, bought a hell of a lot of Dogecoin, after all he does have a lot of cash now, and then proceeded to pump it with that tweet. Now, for anyone in the know, I checked the DH5 wallet and there weren't any transactions, but as that wallet is now widely regarded as belonging to Elon's, I wouldn't expect him to keep using it anyway. Now, sorry for that little detour regarding Dogecoin, I just think it's a little bit odd and a little bit dodgy, to be honest. Now, in terms of normal currencies, fiat currencies, there weren't any major changes. Most currencies pretty much held their ground, but the yen did actually rise 0.4%, so a little win yesterday for the yen after a pretty tough time of it recently. So now, why did the markets have a bit of a nervy and drop a pretty strong amount, especially after seeing such a strong rally just a couple of days ago? Well, once again, it's all based on the Fed, but this time not on Jerome Powell. Basically, lots of people are very unhappy with the state of the Fed, the lack of action that the Fed has taken regarding ending the asset purchase program and raising interest rates, and so lots of people are speaking out and applying pressure onto Powell to actually do something. This is, of course, increasing the likelihood of the Fed actually doing something, which is then frightening the markets a little bit, and that's the broad reasoning behind why the markets took a pretty major dip today. There was also some news regarding vaccine mandates and the Supreme Court blocking that mandate, and that has worried markets a little bit as well. Now, the basic idea here is that the mandate would supposedly reduce the spread and the impact of the virus, and failing to get it through and become law would supposedly cause the virus to impact the economy more, and so markets are a little bit unhappy about that as well. To be honest though, I think the more important factor regarding yesterday's dip was about the pressure on the Fed, which we're going to explain a little bit more now, and then we'll cover the vaccine mandate in a few minutes' time. Now, the really interesting thing about all this pressure being applied to the Fed is that there has actually been a fair amount of pressure from within the Federal Reserve, from other officials asking the Fed to act against inflation. The Fed's governor, Brainard, who was potentially going to take over Jerome Powell's job if Biden had chosen to get rid of him, well, she has come out and said that officials could boost rates as early as March in order to ensure that inflation starts to come down. The Federal Bank of Philadelphia's president has come out and said that he would like to see 4 interest rate rises in 2022, starting in March as well. The Federal Bank of Chicago's president basically said the same thing, that 4 interest rate rises were probably going to be necessary in 2022. And the Richmond Fed president basically said that come March, they should get on with raising rates. What we're basically seeing here is a bunch of other officials at the Fed being a little bit unhappy with the way Jerome Powell has been running things, and they're using their positions and their voices to try and apply pressure onto him to get him to actually act against inflation. The markets seem to think that this pressure has a decent chance of working, and that this will lead to more interest rate rises and maybe greater interest rate rises as well in the future. Of course, we've talked about it loads before, but higher interest rates is bad for growing companies, or any company that needs to raise capital basically. And tech stocks, before they reach maturity at least, always need to raise capital, so their growth prospects will be hampered by these interest rate rises, and valuations are adjusting to that accordingly. The overarching theme that investors are really talking about here is the rotation away from tech and towards value companies, the types of companies that Warren Buffett is likely to own, as they have a better chance of performing well in the coming tighter monetary environment. Now, what's going on with that vaccine mandate news? Well, Biden has, of course, been pushing for more people to get vaccinated, not only with their first and second doses, but with third doses as well. The only problem is that not as many people are getting that third dose as we had expected. Lots of people seem to just be getting a little bit complacent, they're not too bothered about it, or they don't think the third dose is necessary. Whatever their reasoning is, those people exist. Biden obviously doesn't want the virus to take hold again and damage the country again, so he's pushing to get people to take these booster shots, especially since the Omicron variant is a little bit better at getting around the vaccine, and it seems pretty clear that a third dose is necessary to protect most people. So Biden's plan was for a law that would require about 18 million people to either get their third jab or undergo periodic testing to ensure that they don't spread the virus. This was a very controversial thing for him to do, especially in the US, where, of course, personal rights and liberties are taken far more seriously, at least compared to other places like Europe. There has been a legal battle going on to decide whether or not Biden's rule should be allowed, and the Supreme Court just ruled against the whole thing and shot it down. This, by and large, is a win for liberty in the US, but of course not everyone is going to agree with my take on this, and I fully expect to read some slightly annoyed comments down below. I'm more than happy to hear everyone's arguments regarding this issue, but to be honest, I think the Supreme Court did a good thing here. They did, however, let a separate rule take effect that required shots for workers in nursing homes or hospitals or just healthcare facilities in general, specifically though ones that receive Medicare or Medicaid payments from the government. This one is, of course, a little bit less stringent, and it's more related to the government funding that these facilities receive, so it certainly isn't as authoritarian as the other rule, but it's still a pretty controversial ruling. And again, there are no doubt loads of people who either love this ruling or hate it, and those people are more than welcome to duke it out in the comments section down below. Now we move on over to the east with some updates regarding China, and things aren't looking great. The CSI 300, which is basically just the 300 biggest and most traded public companies in China, well, it's now down 18% from its all-time highs in 2021. There was a big slide yesterday that brought it down to this point, led by a rout in consumer shares. Companies which sell to Chinese citizens offer fears that the Chinese economy is not doing too well. Real estate developers, of course, also saw their share prices fall, as is totally expected at this point in this time. But this time it's off of news that Chinese banks are starting to get a little bit unhappy about funding future Chinese real estate projects. This also shouldn't be a surprise. Why would a bank want to fund a project that would likely just result in the loan not getting repaid? Another problem that the Chinese markets have been facing is foreign investors cutting loose and just leaving their markets, with about $100 million in capital a day leaving the country's markets in net terms. Now this is fully expected. It's capital flight at play, and it's what happens when governments erode trust in financial systems and investors get scared of what's going to happen next. Now, Evergrande in particular is in the news as well, though this time it's actually sort of good news. I mean, it's not actually good, but isn't bad either. Basically, the company was unable to pay one of its onshore bonds, which is really not good news. They have, of course, already failed to pay offshore bonds, but foreigners own those bonds, so Chinese people don't really care about that all that much. Defaulting on onshore bonds, however, would mean that Chinese investors would get hurt, and that would not be pleasant at all. So, as Evergrande couldn't pay this bond, they went to the bondholders and asked if they could have an extension for when the bond is due, and they were just given that extension. Again, this sounds like good news on the surface, but the problem here is that this doesn't fix any problems. Evergrande isn't selling any apartments. They don't have enough cash to pay off any of their debts. They don't have enough in assets to sell them and pay off their debts either. This just kicks the can down the road once more. The bondholders also got Evergrande to sign something saying that they promise to pay their debts in the future, and apparently that helps the bondholders sleep at night. I personally think that's a little bit ridiculous, to be honest, but it's not exactly doing any harm, is it? Now finally, in news from the east from China, we see more censorship at work as a prominent Chinese economist has been banned from social media after posting a few things asking the CCP to encourage births in the country using stimulus payments. To be honest, what he's saying actually makes sense. China has a population crisis that is only going to get bad and worse in the next few decades, and it's all due to their one-child policy. This economist, though, was probably seen as a little bit too critical of the party, so he's been silenced, and we no doubt won't hear from him anymore. Funnily enough, though, he actually used to work with Evergrande, but left his role there last year after pocketing a cool $10 million in salary from the company that was destined to one day collapse. Needless to say, it doesn't seem like he's in the CCP's good books. Now in Turkey news, we have just seen Erdogan blaming Turkey's currency crisis on foreign financial tools, whatever that means. Of course, he is not looking very popular right now. His country is in turmoil, inflation is now sitting at 36% on official figures, and it's probably far worse than that in reality. The lira as well has lost 44% of its value over 2021 alone, and about 90% of its value over the last 10 years. Erdogan is trying to shift blame onto some random foreign boogeyman, maybe foreign interest rates or something like that, foreign investors, but the truth is, of course, that this is all his fault. It's the fault of his awful monetary policy, his weird fixation on low interest rates, and his refusal to admit his mistakes. The country's central bank reserves are also starting to run out. The country only has about $70 billion in foreign currency left, and if it continues going on as it has, then it'll run out completely in a year or two. Needless to say, things are not looking good for Turkey. Now, in Tesla news, I know some of you love updates on Tesla. Well, the Cybertruck has quietly been delayed for another year. Is this surprising? No, Tesla delays things all the time. Remember the Tesla Roadster that we were supposed to get 5 years ago? Is it here yet? No. Remember the semi-truck? Is it here yet? No. Remember full self-driving? Is it here yet? No. This is very normal for Tesla and not at all surprising. It is worrying to those who don't have huge levels of conviction in the stock. I personally like the companies that I invest in to just be honest and hit their targets first time round, but Tesla investors seem just not to be bothered by this type of stuff. They tend to concentrate on the successes like the huge growth in deliveries, which has been very impressive, but personally, I like to look at the negatives as well. Negative visualization is a powerful tool, and I definitely think more people should consider using it. Now that is pretty much it for the day. I will see you all again tomorrow. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting then make sure to check it out. There's also a link in the description to BLOCKFI, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Just make sure not to use Tether. Thank you all for the support, thanks for watching, stay stoic, until next time.